try to start without mic. I'm Alexander Chepurnoy, a co-developer of Ergo. Did some research also before IHK, mostly cryptography and blockchains, but also published one actually paper in alternative monetary theories venues, and this is the paper also about a kind of alternative monetary system, but it is implemented on the blockchain, so it's kind of mix of all those topics you can find in this presentation. So it's called money creation with elastic supply via trust and blockchain assets in a global digital peer-to-peer environment. Right, so a lot of similarities with original Bitcoin white paper, for example, like peer-to-peer environment, and yeah, we have blockchain on here, but we are going to talk primarily about creation of money, right, in blockchains, and not only, and what can be done better when it comes to create better money in bulk. So how money are created now, so in the real world, not cryptocurrency space. So they are mostly issued by private banks via fractional reserve credit system. So there is maximum elasticity here, so like trillions can be created in like days, right? Trillions of dollars, and yeah, it's based on trust only to the guidance, right? Mostly, so private banks are following some instruction from regulators, and initial liquidity and so on, and then yeah, well, they're expanding this liquidity heavily via fractional reserve. Then we have commodity-based currencies. Actually, in some areas, it can be seen as the next step. So, for example, Zimbabwe, after failing trust-based fiat system, now has basically tokenized gold-backed currency. I've forgotten the name, but yeah, there are a few cases, I believe, now across the Africa. Sometimes there are commodity-backed currencies used in international trade, and so on. Also, yeah, there are some community currencies of that kind. So it's not elastic at all, right? So you cannot create trillions in days, right? Because, well, you need for reserves, you need to get gold or any other commodity in reserves to print money, commodity-backed money, right? So then this option is not popular, right? So been historically first. Then it lost popularity because of no elasticity, right? So supply of money is not connected with demand from economy. Then we have local and community currencies, maybe not so big phenomenon in comparison with fiat money, but still it does exist. Usually they are based on local trust, on peer-to-peer interactions in communities, trust in local government issuing some monetary tools. There are time banks and so on, right? So they are somewhat elastic, right? So, well, supply is usually met demands, but only in local environments, right? In some community, local community. So those solutions are not global. Then we have cryptocurrencies. So the first was Bitcoin, which is now considered as kind of digital gold, right? Despite the original white paper title claiming that Bitcoin is peer-to-peer electronic cash system. So now it's mostly perceived as digital gold. As money, it's not elastic at all, right? So it's mostly failed actually as medium of exchange, right? So mostly considered as store of value and store of value kind of speculative instruments these days. It doesn't have elastic supply because the supply is just some function of time basically, right? So there is some schedule which is hard-coded, and there were no changes to the schedule except of some bug fixes. It's set in stone basically, and not met demand from real world economy. Then we have algorithmic stable coins, which are not stable historically, such as new shares, Luna, and so on, right? If they are not over collateralized, they're not stable. So now it makes sense to talk about over collateralized options only, but then such options are not elastic because usually how over collateralized algorithmic stable coins work. So you put some blockchain assets like Bitcoin into reserves with over collateralization, right? So if Bitcoin, for example, or any other proof of work cryptocurrency is not elastic, then over collateralized derivative is not elastic as well, right? It's even worse by the requirement to meet demand from the real world needs. Then we have trust-based stablecoins such as USDT, USDC, and so on, right? Which are quite elastic. So, in cryptocurrency media, they are often write about multi-billion issuance, happening all the time on Tether side. So Tether can issue a lot, right? Especially in comparison with cryptocurrency assets. But then it's based on trust. So initially Tether wasn't regulated, so it was about some blind trust to Tether guys and the offshore structures only, right? Now it's regulated, so they're showing reserves, they're obliged to do some things. From what I know, they're obliged to have transparency, somewhat transparency at all, but then it's not different from traditional banking system, right? And having the same trust assumptions, basically. This inelasticity of supply of blockchain assets is actually problematic, right? So it's one of the oldest issues being discussed on Bitcoin Talk forum, for example, since 2010, right? When people are started to realize that it's not working well as peer-to-peer cash, right? And discussion started back then, back in earliest days of Bitcoin. what to do with this disconnection from economic activity. And yeah, well, I've covered those issues, I believe, mostly of inelasticity. And then there is demand still, right? It was back in 2009, and yeah, it is still the very critical problem, the need for good money around the world, and the need for good money in bulk, right? So not just some exotic cryptocurrency or well, algorithmic stable coin. So in recent years, there were a lot of examples, especially around 2023, a lot of countries reported a shortage of US dollars for international trade. So Ghana, for example, started to buy oil with gold instead of US dollars, simply because of US dollars shortage. So DXY index, dollar dominance index, was at record high levels. And so, yeah, African countries such as Ghana, Egypt, and so on reported shortage of dollars, and yeah, different countermeasures such as using gold and so on, right? But yeah, such instruments are not quite solving the problem, like buying oil with physical gold. Well, it's a very limited solution, right? So we need with the digital world possibilities for something better. So what do you want to achieve ideally is decentralized peer-to-peer monetary system with no external control over issuance and acceptance of money, right? So somewhat decentralized and unstoppable. Then it should be global, so from Africa, India, and other places around the world, it should be freely accessible. Then it should have elastic supply, this monetary system, right? So then, yeah, if we are talking about peer-to-peer system, then anyone can issue money, right, at any time. Then in such system, how to avoid issuance of bad money. So the only solution is to make acceptance of money optional, right? So anyone can issue money, but it is a right of payee to accept a note or to reject it, right? And this is actually historically quite known thing. So before central bank money, we had in many places around the world so-called free banking systems, right, where private banks issued their own money with a shared unit of account. So, for example, over the internet, you can find a lot of different commercial banks, US dollars issued before the Fed, before 1913. And yeah, so it was the same unit of account, US dollar, but different banks, and acceptance was optional, right? So it was possible to reject the dollars issued by Massachusetts Bank, for example, or some Kentucky Railroads Bank. So there was no law, right, enforcing to accept all those commercial banks dollars. All right, so we are doing now quite similar to free banking, but now with transparent reserves, right? So the common issue with free banking systems were scams basically, right? Grift. So often it wasn't known to people using those commercial banks dollars how much a bank has in reserves, right? So what's the collateralization and so on. And so with blockchain, now this problem is solvable, right? So we can have transparent reserves, and we can have smart contract based redemption. So no bank can stop redemption, right, of issued notes. Okay, so how can we do that? The system is called ChainCash because there is also optional chain of backing. I'm going to explain. So the main things, the main entities we have here are reserves, right? So basically self-sovereign free banks reserves, and everyone can be a bank, right? So like everyone in this room can run own bank and yeah, have reserves. Then there are notes which are issued against those reserves, but not necessarily covered, collateralized. So it's individual option to cover or not, as well as it's individual to accept or not such notes. If you are familiar with blockchains, it's better to know that UTXO accounting model is used, which is derived from Bitcoin. So in short, UTXO is when you have a possibility to spend many nodes and create new nodes in a single transaction, right? So unlike cryptocurrencies like Ethereum and so on, so-called account-based cryptocurrencies, where you have accounts and contracts like bank accounts. So here you just have nodes, right? And a single transaction may spend multiple nodes potentially and create multiple nodes as well. Okay, so then everyone may have reserves in native tokens. So the implementation is done on Ergo blockchain, so ERX, or other digital tokens such as tokenized Bitcoin, stable coins, whatever, right? So tokenized real-world assets such as tokenized physical gold and so on. Then, again, everyone may issue notes of arbitrary values with or without reserve. So it's possible to have zero reserve and still issue notes, but then it's trust-based only, right? The acceptance is trust-based, and a note may be accepted by counterparty depending on collateral and trust, or maybe not. So it's up to payee to accept a note, you know. And a note may be redeemed against any reserve of its previous spenders at any moment. There are some complications here about some time periods when it's not spendable. But yeah, for simplicity, let's keep all those details for now. Okay, and the design is actually a bit similar to spender-signed currencies, which was quite popular concept in Japan back in early 2000s, so even before Bitcoin. There were some peer-to-peer digital cash systems from 2003 basically, and the most comprehensive works from H. Morino, and implementation of peer-to-peer network is described by Kenji Shaito, peer-to-peer money free currency over the internet from 2003. So like 6 years before Bitcoin, right? And so how does it work? So well, electricity kilowatt per hour was used as unit of account, and then how does spender signed currency work? So, for example, Alice is issuing a watt ticket tied to kilowatt per hours. Then she pays Bob with it, then Bob signs and pays Charlie, Charlie signs and pays Diana, right? So it's to be signed when being spent, right? And then you are getting a signatures list, right? And when the ticket is getting back to Alice, liquidation happens, right? So it's making full roads, and there are no obligations if it's circling back to Alice. And signatures list basically is showing collective trust Alice has. So, well, but back then there were quite popular ideas about building peer-to-peer reputation systems, web of trust. So yeah, it's also kind of this kind of systems. Then yeah, how it's different. So in ChainCash, gold is used as unit of account, right? So there is a single unit of account for the whole system, 1 milligram of gold. And then, for example, Alice having some reserve in ERC, so Bitcoins or stable coins, issuing a note. Then she, for example, pays Bob with it. Bob then signs and pays Charlie. Charlie, well, signs, pays to Diana. And then Diana may redeem in ERCs according to gold price delivered by an oracle against Alice reserve. But actually it's possible for Diana to redeem against Bob, for example, right? And then Bob is getting a receipt, so it's supported by smart contract. And Bob can then re-redeem against Alice, right? So, well, it's always possible to redeem. And yeah, another example, for example, Charlie is running a charity, right? So Charlie doesn't have any assets to be put into reserve, so he's issuing a note without any reserve. Then Alice does accept it because she's willing to help the charity, right? Charlie is a whitelisted charity in her software. Then yeah, she may pay Bob with it. Bob may pay back to Charlie, right? And then Charlie can even redeem in this case, right? So it's not prohibited. And yeah, so here we have like people, Alice, Bob, Charlie, right, in our examples, but actually it's public keys. So what I'm thinking about, so a single person may have at least 2 public keys, right, in the system. One for entity with reserve, public key with reserve, another without reserve, right? And then it's up to the person, which public key is used to accept a note, right, and to pass further. So whether to allow to redeem against reserve or not, right? It's another option here. So then, yeah, it's quite flexible system, right? Which is combining peer-to-peer trust, as you can see, along with reserves. So, well, in some roads here, it can be like stable coin, collateralized stable coin, right, can be considered. And in another roads and other use cases, it can be as trust-based mean of payment, right? So then it allows for elasticity, and monetary expansion is defined by trust in this peer-to-peer system, right? So maybe it's hard to predict,
the degree of expansion, but yeah, the system has it at least, right? So yeah, then we have implementation as layer one contracts. There is implementation for node and the reserve contract. And so on. There is off-chain server, which is tracking reserves, tracking nodes, allowing to issue nodes, redeem, and so on. Yeah, well, we are looking for contributors. It's always welcome to contribute to this open source software, even though it's under a public domain license. So kind of common property. So yeah, please feel free to contribute to the off-chain software. And then yeah, we've considered different extensions on top of this flexible basic design. So one option considered is local exchange trading system, right, which is kind of IO community node system, community currency system, which was popular, for example, in Argentina back in 2001 when bank system collapsed. There were 800,000 users of different local exchange trading systems. So we've shown how to implement this on top of ChainCash. Then we've shown how to do mutual credit clearing, right, to maximize efficient usage of reserves when there are mutual obligations, right, which can be cleared, and we are showing how to clear obligations in a single atomic transaction, right, so without having trust them. Then there is a variant which is called Basis, which doesn't have this chain of spending, so it's about a single on-chain reserve only. But then we have off-chain cash implementation with possibility to create credit off-chain. And yeah, in this off-chain credit system, we need to have for some watchtower basically who is tracking well nodes created off-chain, right, and it's accounted in on-chain contracts as well. But well, the role of this trusted entity is minimal, just to track nodes, and in different communities, for example, different trackers may be used, so it can be considered as BitTorrent like design, right, when you choose your tracker, but it's not torrent tracker, it's money tracker, right, and yeah, it's also minimally trusted, so the only role for tracker is to track nodes created off-chain, and yeah, to provide overview of credit created off-chain. Yeah, so I think I've already explained free banking in detail. So yeah, this ChainCash system can be seen as a digital revival of free banking system now with transparent reserves and so on. And yeah, well, we have elasticity here, which cannot be predicted ahead of time, and even more probably elasticity would be changed naturally, right? So during good times, collateralization requirements would tend to go lower, right, and the trust would tend to be expanded, right, in the system. Yeah, well, it's happening in all the economies, right, during good times. Then during crisis times, yeah, it's the opposite, right? And then there would be actors with different appetites for risk, right? So some may accept nodes with low collateralization, maybe under collateralized. Some actors would be cautious and accept nodes only over collateralized, right? Some actors may be there for fun or to help charity, so they accept only based on trust, right, from known entities, and so on. So this digital free banking system, ChainCash, can be seen as a monetary system which would allow for elastic money supply, but also with freedom to choose, right, which money do you hold, so what is the quality of money in your pocket, basically, right? So it's not enforced by the system, it's your own individual choice. So I think it's covered enough for now. Thank you for your attention, and I would be happy to answer questions.
Any questions?
Like suppose when Bob is issuing a note to someone, he has some collateral in the smart contracts.
Yeah.
Suppose note transfers to many persons, and when he reaches to says Martin and he want to redeem it, but at that price the gold price goes up. So your note is pegged to the gold price or with the dollar only?
Right. So yeah, as gold prices fluctuating against the base asset, right, ERC or stablecoin, US stablecoin, for example, or Bitcoin, whatever, right? So yeah, collateralization level is also changing. So the idea is that software would track it, right, and redeem when possible. So it's not done yet, but yeah, potentially you can just set in software config, right, when to redeem. So when it's getting risky for you personally, yeah, you are going to redeem. So currently software is supporting such settings as whitelists, blacklists, so whom do you trust unconditionally, right, depending on collateralization, whom you don't trust at all, so you blacklist their notes. And then there is also option to set collateralization level, but yeah, it's only about collateralization level during acceptance, right? But then, yeah, well, it's not hard to add this tracking part, right? So, well, yeah, your software will just refresh collateralization for the nodes you have and redeem whenever it becomes risky for you. So it will be another number in config file, which is telling your risk tolerance, basically.
So is there a concept of liquidation, or does it happen on the basis of the receiver when he wants to redeem it?
Yeah, so it's not liquidation, it's redemption, right? It's called. So you are not liquidating the whole reserve, right? So you are just redeeming your notes against it. Yeah.
Okay. Thank you.
Any other question?
Can you explain the centralization risk of the off-chain component?
Centralization.
Risks of the off-chain component that you described.
But off-chain components here is software which you run locally, right? So maybe with time, many people would trust some hosted options, right? So some server which is hosted somewhere, but then it's your own choice again. I mean, I cannot do anything with that. If people do trust some servers from outside, it's their own choice. But yeah, well, originally this is software you run locally, like Bitcoin node, right? And then it's tracking your own nodes and yeah, accepting new nodes and so on. And so yeah, well, about acceptance, right? So as you can see, as acceptance is individual, right? So first you need to contact payee, right, to ask whether a node would be accepted or not. But it could be inconvenient, right? So in most cases, in digital world, we assume for non-interactive payments, right? So you just send bitcoins to some address, for example. But here it's also can be handled. So if you run a shop over the internet, for example, if you're a merchant, you can just publish your acceptance predicate, right, on the website, and then a payer can decide on his side whether a node would be accepted or not. So in this case, there is no need for interaction even. There is no support for that, like generation of QR codes and so on, right? But yeah, I mean, it's quite straightforward to this functionality as well. So yeah, the idea is that merchants and other people, entities interested in being self-sovereign parties in this free banking system would run their own software, right? Their own ChainCash server.
Any other question? Okay. Thank you, Alex.
Thank you a lot.